The rule change dropped at 3 a.m. No press release, no warning, just a quiet update buried on the exchange website while the world slept. By the time traders woke up, the trap was already set. The COMEX had doubled margin requirements overnight. This wasn't a routine adjustment. This was a coordinated strike designed to force liquidation. The banks watched silver break through $75 and realized they were staring at total insolvency. Their short positions, built over years of manipulation, were about to detonate. They had one option left: change the rules mid-game. They couldn't beat the market, so they rewrote the scoreboard. The margin hike is a weapon disguised as risk management. When you trade silver futures on the COMEX, you're using leverage. You deposit cash, say $10,000, to control a position worth 10 times that amount. This system functions smoothly until the banks start bleeding. The new rule forces traders to deposit double the cash by market open, or their positions get liquidated automatically. No negotiation, no grace period. The exchange becomes the enforcer, selling your winning trade to save JP Morgan's balance sheet. This is theft by policy. But the margin hike was just the opening move. Reports are flooding in from multiple brokerages. Buy buttons disabled. Traders attempting to open new silver positions are hitting error messages. Risk management limit reached. Trading restricted to liquidation only. You're allowed to sell your silver back to the banks at their suppressed price, but you cannot buy more. This is the GameStop playbook, refined and deployed. When you remove the ability to buy but leave the ability to sell, the price can only move in one direction. They're manufacturing a price collapse through artificial supply restriction. While retail is locked out, the banks are deploying their algorithms at full force. This morning, massive sell walls appeared on the order book. 5 million ounces offered at $76. The market saw that size and panicked. The price dipped. Then, milliseconds before execution, the orders vanished. This is spoofing, placing fake orders to manipulate sentiment, then canceling before they fill. The banks never intended to sell. They wanted to create the illusion of overwhelming supply to trigger stop losses and shake out weak positions. It's a psychological operation executed through the order book. The exchange itself is complicit. The COMEX is supposed to be a neutral referee ensuring fair price discovery, but the exchange is owned by the banks it regulates. Board members are former executives of the very institutions holding the short positions. When they raise margins and restrict trading, they're not protecting market integrity. They're protecting their friends from bankruptcy. The exchange has abandoned any pretense of neutrality. It's become a tool for institutional survival, rigging the game whenever the house starts losing. This isn't new. In 1980, the Hunt brothers accumulated enough silver to drive the price to $50. The banks faced collapse. The exchange responded by implementing Silver Rule 7, which allowed traders to sell but not buy. The price crashed from $50 to $10 in weeks. The banks survived. The Hunts were destroyed. They're running the same playbook today, betting it works again. But there's a critical difference. In 1980, the demand was speculative. Today, it's industrial. Apple, Tesla, and Sony need physical silver to manufacture products. You cannot tell a factory to liquidate only when they require metal to keep production lines running. Rule changes might terrify speculators, but they cannot override the laws of supply and demand. The banks are fighting physics, and physics doesn't care about margin requirements. The most damning evidence is the spread between paper and physical. While the COMEX price is being suppressed through margin hikes and spoofing, the real-world price is exploding. Physical dealers are charging 40% to 50% premiums over spot. Why? Because spot is fiction. The paper price is a number agreed upon by thieves. The real price is what you must pay to get metal delivered to your vault. The market has split into two realities: the banker's price on the screen and the people's price in the physical world. The spoofing isn't random. It's coordinated across multiple exchanges, timed to hit during peak trading hours when retail participation is highest. The banks deploy massive sell orders, blocks large enough to move the entire market, then pull them the instant price momentum shifts. This creates a pattern of false resistance levels. Traders see a wall at $76 and assume that's where selling pressure exists. They adjust their strategies accordingly. They set stop losses just below that level. Then the wall disappears, the price drops through their stops, and they're liquidated. The banks buy back the contracts at the lower price, pocketing the difference. This technique exploits the psychology of the order book. Most retail traders rely on visible supply and demand to make decisions. When they see 5 million ounces for sale, they interpret that as genuine selling interest. They don't have the tools or the speed to detect that the order is phantom. By the time they realize it was fake, their position is already closed. The banks are weaponizing the transparency of the market against the participants who trust it. The algorithms executing these spoofs are faster than human reaction time. They can place and cancel orders in microseconds, staying ahead of regulatory detection systems. The exchanges claim they monitor for this behavior, but enforcement is selective. When a retail trader accidentally triggers a similar pattern, they face fines and account suspensions. When JP Morgan does it systematically, the exchange looks the other way. The rules exist to punish the small players while protecting the institutions, but the spoofing reveals desperation. If the banks were confident in their position, they wouldn't need to fake supply. The fact that they're deploying these tactics at scale means they're terrified of the buying pressure. Every fake sell wall is an admission that real supply is gone. They're trying to create the illusion of metal availability to prevent panic buying. It's a bluff, and the market is starting to call it. The psychological operation extends beyond the order book. Financial media is running coordinated hit pieces, calling silver a bubble and warning of an imminent crash. These articles cite anonymous sources and market experts who predict the price will collapse back to $50. The timing is too perfect to be coincidence. The same day the margin hikes are announced, a dozen outlets publish bearish silver commentary. This is narrative control, designed to make you doubt your position and sell into their manufactured weakness. The banks understand that most traders are emotional. They know fear is more powerful than logic. If they can make you believe everyone else is selling, you'll sell too. That's the goal of the spoofing, the media blitz, and the margin hikes. Create enough fear to trigger mass liquidation. They're betting you'll panic before you realize the fundamentals haven't changed. But here's what they didn't account for. The internet. Traders are sharing screenshots of the spoofing in real time. They're documenting the fake walls, the canceled orders, and the coordinated media attacks. The information is spreading faster than the banks can suppress it. The playbook that worked in 1980, when information moved through newspapers and phone calls, is failing in an era of instant communication. The more they cheat, the more evidence accumulates. They're creating a permanent record of their own manipulation. Buried in the COMEX user agreement is a clause most traders never read: force majeure. This provision allows the exchange to void contracts and settle in cash if they declare an emergency. Translation: if the banks run out of silver to deliver, they can simply announce they are defaulting and pay you yesterday's manipulated price instead of the metal you are owed. This isn't a theoretical risk. It's the endgame they're engineering right now. The margin hikes and trading restrictions are setting the stage for this declaration. They're trying to crash the price before they're forced to admit the vaults are empty. If they can drive silver back to $60 through forced liquidations, they can declare force majeure at that level and settle contracts at a massive discount to where the market was trading. You bought at $75 expecting delivery at $100. They'll hand you $60 in cash and call it resolved. This is legal theft enabled by fine print and regulatory capture. The banks are already drafting the language. They'll blame unprecedented market conditions and supply chain disruptions. They'll claim they acted in the interest of market stability. The regulators will nod along because the alternative is admitting the entire paper market is a fraud. The Federal Reserve will support the decision because allowing JP Morgan to fail would trigger a systemic banking crisis. They're coordinating the narrative to make the default sound reasonable, even necessary. This is why they're so desperate to suppress the price now. Every dollar silver rises increases the gap between the contract price and the settlement price they'll offer. If silver hits $100 before they declare force majeure, they'll have to settle at $100 or face lawsuits that expose the fraud. But if they can crash it to $60 first, they can claim the settlement is fair market value based on the manipulated price. The margin hikes, the spoofing, the media attacks, it's all designed to create a lower settlement baseline. The vaults tell the story they're trying to hide. COMEX inventories have been draining for months. Eligible silver, metal available for delivery, is at multi-year lows. The registered category, which backs the futures contracts, is a fraction of the open interest. There isn't enough physical silver in the system to satisfy even 10% of the outstanding contracts if holders demand delivery. The banks know this. The exchange knows this. They're just hoping you don't figure it out before they pull the escape hatch. China is watching this collapse in real time. The Shanghai Gold Exchange operates outside COMEX jurisdiction. When the West suppresses the price through paper manipulation, China accelerates physical purchases. They're draining Western vaults at artificially low prices, transferring strategic reserves from New York and London to Beijing. The American banks are so focused on short-term survival that they're selling the country's metal supply to a geopolitical rival. They're trading national security for quarterly earnings. The industrial users are reaching their breaking point. Tesla, Samsung, and Sony need silver for production. When the exchange rigs the market, it destroys their ability to hedge costs and plan manufacturing. We're hearing reports of major corporations abandoning COMEX and negotiating direct supply contracts with miners. If the industrial buyers leave, the exchange loses its last claim to legitimacy. It becomes a pure speculation casino, disconnected from the physical market it's supposed to represent. The rule changes prove the banks have lost. They're rewriting the game because they cannot win by the original rules. Every margin hike, every disabled buy button, every spoofed order is an admission of defeat. The physical deficit is real. The vaults are empty. They can manipulate the paper price, but they cannot create metal. Hold your position. Demand delivery. The system is burning, and the ashes will reveal who was holding real wealth.